Welcome to the Compliance Network podcast, your compliance community. Since 2014, we've been helping financial services companies understand and follow the rules that govern the industry. Whether you're nearby or across the globe, we're here for you. Let's jump into the latest trends, tips, and updates in the ever-evolving world of regulatory compliance.
Hello, everyone, and we are back with episode number 2 of the Compliance.Network podcast. Your co-host here, Jeremy Wolf, joined by your host, Kevin Rowe. Kevin.
Hey, Jeremy.
Good to see you again.
You as well. You as well.
So we're going to do a little segment here called Regulation Rundown, right? The topic would be key regulatory changes in 2024, what you need to know. So first of all, why don't you start off by explaining some of the, now that we're, getting close to the end of 2024 already. It's amazing how time seems to fly faster and faster the older I get.
Definitely.
What are some of the key changes that you've seen and you've worked with throughout the year so far in 2024 that businesses need to be aware of?
Absolutely. Absolutely. So I would say that the regulatory environment has always been focused on the investor. However, now the regulators have a tool and a rule designed to help them enforce the requirements and understanding clients before they invest in a product. So it's not a new rule, but regulation best interest enforcement cases have been up in 2024. Regulation best interest first came to existence in 2020, and the industry is starting to really feel its shockwaves. This is really beneficial for retail investors. You and I, for example, would be retail investors. Anyone we can think of that doesn't have annual income of $250,000 or assets over $1 million are just retail investors. And so there's been a focus on the best interest. In the past, the regulators have said that maybe brokers and brokerage firms and investment advisors were acting in their own best interest instead of the interest of the client, which means that they would sell maybe products that had higher fees, more complicated products. But regulation best interest has 3 components that all of the firms have to adhere to. And so we've seen, even in 2023, about 7 exams with a heavy, intense focus on regulation best interest. Included in that would be the reasons why a registered representative would solicit a trade, or, you've probably seen in the movie Wolf of Wall Street, where he's on the phone early on and he's calling and he's saying, hey, yeah, I've got this XYZ stock and I'm selling it. It's going to go quick. The famous scene with the doctor where he kind of pumped that stock up. Well, obviously, that isn't the behavior that we want to see in our industry. And so our regulators have done a really good job in putting in the rules to help avoid, or at least capture or catch those kind of guys before they can do a lot of harm. Another big item would be, again, focused on retail investor protection, which is the increased scrutiny of complex products. So a reverse leverage ETF, if you're soliciting that as a registered rep or as a client being asked to buy something like that, it's a super product, if you will, in the sense of the different ways that you can make money. But now the firms are forced also to give alternative options to that amount of risk. So we've seen an enhanced focus on the regulators in that area. Cybersecurity. We don't really think about when we send an email, what happens to that email, or if someone can spoof our email address. I would say that a lot of times, especially from the broker-dealer view and the compliance officer view, we find that clients' email compromises have compromised the broker-dealers because we're receiving the emails from someone who purports to be one of our clients, but actually is not. So there's a lot of focus on data protection as well. And then lastly, AML. There's a lot of
anti-money laundering.
Yeah, anti-money laundering. So from the regulators, or actually the Congress passing the Patriot Act back in 2001. We have a lot more enhancements. As you can imagine, 23 years later, the expectation now is that broker dealers and investment advisors monitor, more so broker dealers, monitor high risk accounts based on their profession, but then also where they're located geographically. So that's more of a concern for the broker dealers, but not the investing public.
Now, I know a lot of these regulatory changes come off the heels of litigation, correct?
That's correct. Enforcement actions. Cases.
Enforcement actions. So specifically, I let's discuss a FINRA case. I won't give the case number or anything, or maybe you can if you want. It was involving JP Morgan Securities. You're familiar with that case?
Yes.
Well, first of all, explain the case briefly, like the main issues in the case, and then how that translated into some of these new regulatory changes that we saw in 2024.
Absolutely. So even a scenario where Mr. Investor, retail investor, invests his funds, his money, however he wants, and he doesn't have someone calling him with trading ideas, broker dealers have to supervise that activity. And so in the JP Morgan case, what we found, or what FINRA found, was that JP Morgan did not do necessarily a great job in monitoring and reporting manipulative trading practices because they did not have a supervisory function. So within every broker dealer, you're required to have policies and procedures, but you also have to designate supervisors, who are people who have a particular examination test. We call it a Series 24 or Series 14, and there's a few others in different aspects of the business, but they're required to oversee the business. And so in this particular case, FINRA found that there was enough evidence that JP Morgan did not have an adequate supervisory system to monitor high volume trades.
When you say FINRA,
yes,
please explain what that is for any listener out there that hears that and they've heard it before, but they just don't know what the acronym stands for.
Sure. Financial Industry Regulatory Authority.
Okay.
FINRA was preceded by the NASD, which is the National Association of Security Dealers, which was formed in the 1934 Act, just after the Great Depression. So with the way that the market crashed in 29 and 30, what the government did was to try to prevent that from happening again. They put in rules, and then they designated a self-regulatory organization. So the self-regulatory organization in our world is FINRA, and FINRA is oversight by the Securities and Exchange Commission, or the SEC.
It's really fascinating to see all these systems that are put in place. I know a lot of times, I think a lot of people, they get frustrated with red tape and regulations, but there are certain areas where it's so important to have that, and so important to have oversight. And this is clearly one of them, the financial sector. So it's really important to have people like yourself out there going to bat for businesses and helping them, and also investors, and helping them navigate this, often difficult and confusing process. I want to ask though, why is it so crucial for firms, especially those that are involved in high frequency trading, to have in place robust supervisory systems?
As you can imagine, if you're a size firm as JP Morgan, I mean, that's a pretty recognizable name. Whether you know what business they execute, they may have different lines of business, but in this case, JP Morgan Securities, they have a lot of clients and they have a lot of volume. And so when you have a lot of volume and there are different rules based on the client that you have to be cognizant of or aware of, in this particular case, it's not possible for a human to do it. And so what that means is that you have to create some sort of exceptions program, because the regulatory expectation by FINRA and the SEC is that you address your highest risks first. And so in addressing your highest risks, if you have a lot of trade activity or volume, let alone accounts that may day trade, which means that they may trade the same security repeatedly throughout the day, becomes a pattern day trade account after 4 round trips. You have to make sure that those types of accounts have day trade buying power, and they have 4 times margin in that case. So there's a lot of intricate pieces that there are rules on, but in this particular case, it's important to understand that someone has to look at all of those intricacies. And because of that, FINRA did not find that JP Morgan had done so.
What are, I guess, some of the broader implications of this specific case, the JP Morgan Security FINRA case, for firms dealing with high frequency trading?
The biggest lesson here is to have an adaptable supervisory system, particularly for high frequency trading. The goal here is that you are constantly evaluating your different exceptions, reviewing for new patterns in accounts that are trading high frequency. Big thing here are penny stocks, which are delisted securities that are no longer on a major exchange like the New York Stock Exchange, where they trade in the over-the-counter market. And in this particular case, penny stocks are a lot of times subject to a pump and dump, where someone may call and get a lot of volume and show a lot of volume in a particular security, and then they sell their position, they recoup their funds and make money, while the investor is standing there holding the bag. So the review of your system is important for these broker dealers, not just because of the high frequency, but the type of trading, and really knowing your customer base and understanding what your risk profile is from a regulatory standpoint. How does this impact the investor? The end investor is impacted because now FINRA is saying to the industry that, hey, technology is getting better. Clients are changing. Their investment approach is changing. So you have to be very adaptable to how you supervise your business in the same way that times are changing with the investor.
Interesting. What about just a retail run-of-the-mill investor, right? How important is it for somebody like that that's just doing some day trading on their own to be attuned to some of these regulatory issues? Because from where I sit, for me, I've tried dabbling with that before, and I said, you know what? I'm just getting a professional financial advisor, wealth manager to deal with that, because it was a nightmare for me. But like, to somebody out there that actually is doing that and is making money on their own, how important is it for them to actually be up to speed on all this regulatory stuff, or can they get themselves in trouble if they're not?
Well, they can't get themselves in trouble in the sense that that's what the compliance department at these brokerage or trading firms are for. What I would say, it impacts them because there's a requirement for firms to evaluate whether or not that client can accept the risks. Do they have the financial resources to? Day trading is a pretty high risk trading strategy. Most firms will not allow for you to become a day trader at their firm unless you have an account minimum of $25,000, and you have to maintain that. So if you're taking losses and you fall under 25,000, then FINRA's rules require that your broker dealer restrict your account until you bring that balance up. So there are impacts to the client in terms of their ability to trade. However, the broker dealers are responsible for passing those notices along to the client.
All the more reason why it's important to have a professional to deal with that you trust and that has your best interest at heart and is doing everything right on the compliance side, for sure. All right, well, we'll leave it at that. A lot of stuff to get into. I think you touched upon AML, the anti-money laundering. I think we'll do another segment on that in the future, talking a little bit more about the AML programs in 2024 as well. So good stuff, man. All right.
Absolutely. And Jeremy, before we leave, I'll just remind our investors that they can find information on FINRA's BrokerCheck. The Financial Industry Regulatory Authority has a website called BrokerCheck. It allows for you to search a registered representative or someone that you're working with, and also the firm that they work with. And it gives you information about that firm, any disciplinary history for the firm or the rep. And then also on BrokerCheck, you can download the firm's CRS, which is the customer relationship summary. And it explains to you the different conflicts of interest that the broker and the broker dealer may have and how they mitigate those items, as well as any fees that you may pay. So a tremendous resource, and definitely we encourage our listeners to go out if you're an investor, to do a little homework on who your registered representative and your member firm are. So that way you're not caught by surprise if something were to happen with that firm from a compliance standpoint.
Absolutely. Kevin, you are a wealth of knowledge. So for our listeners out there, if anybody has any questions about any of this stuff, anything that's confusing to them, anything they need clarity on, reach out to Kevin anytime. There's a link in the description to his email, his website. Plenty of resources available. Make sure you follow him on social media. All those handles are in the description as well. Because ultimately, you're here to help and you're here to build the compliance community and make it great. All right.
Right on.
All right. Thanks, everyone, for tuning in. And we will catch everyone next time on the next episode of the Compliance.Network podcast. Everyone, take care. Have a great day.
Thank you for tuning in to the Compliance Network podcast. We hope you found today's episode valuable. Until next time, you may find our community on social media at compliance.network. We are on LinkedIn, Instagram, and Facebook for more insights and observations.